Hey, so this is the June 2026 performance review and not really time for a victory lap yet. The portfolio was positive in Canadian terms, but it lagged the S&P 500 total return benchmark. So the more important takeaway is that the public record is starting to show what needs to improve going forward, which means this entire project is already becoming worth the effort, which is great. So for June, the portfolio returned a positive 1.4% in Canadian time-weighted return. The benchmark was positive 2.01%, so the portfolio did lag by about 60 basis points. But in USD investment terms, the portfolio and the S&P 500 were both negative. So the question is, how could the Canadian return be positive while the USD return is negative? So the bridge is the currency exchange rate. The USD went up or added in June only 2.94% to the portfolio's Canadian return, which is like, I didn't think that was even possible in 1 month. It's kind of crazy that currency exchange rate volatility, like that really moves the needle. So it matters to me as someone living in Canada, trading in US dollars. But that doesn't really equate to any investment skill. It's kind of just luck or randomness. So it's just part of the performance result that needs to be documented accurately. Attribution is a little bit more interesting, and this report gets more useful. And a reminder that the attribution for simplicity is just in US dollar terms, and it's just divided by percentage of beginning NAV at the beginning of the reporting period, which is June 1st. So the core long ETFs of SPY, Gold, IBIT, and SGov, they actually produce negative returns, down 4.61%, specifically because Bitcoin was like down 15% or something. To a lesser degree, gold was also weak, I think a few percent anyways. So the satellite trading or the active overlay trading, it helped offset that with 3.42% of positive gain. And then costs of commissions for option contracts took off 37 basis points. So that means active trading definitely kept this portfolio going this month, but it was not enough to offset the Bitcoin sort of weakness. Okay, so the risk is what I care most about going forward. So June had 12 annual theta breach days, and all the days were breached for trade count. So that's just too much activity and too much reliance on selling options short. The premium selling for options makes a portfolio like look productive in the moment, until the market has like a tail event where like the index goes down 20% or something. So a reminder that the current goal for risk breach days is under 10 per month, and hopefully we get there soon. So the useful lesson from June was that the process was still too dependent on risky short option structures that can become fragile when the market moves hard against me. And I already made another video about that for like my worst trading habit. So this gives me a cleaner monthly review pattern going forward. Like, what did this month expose and what should change going forward? So for July, here's the plan. We want fewer than 10 breach days and less risky short option positions and or structures. I also need a better hedging strategy when I think downside is imminent, because I was really tempted to just like sell off the entire portfolio even after a few days after I got into it, because I knew downside was imminent, and there was some downside, but yeah, there is a way to hedge against that in an efficient way. So I want to build that system going forward. And there's an extra note I have here on the trade count metric, which is breaching for all days so far. It's a rolling 30-day count, so it just looks back the last 30 days and counts literally how many transactions. I'm just thinking out loud though, like if I didn't trade in July at all, this metric will likely still be in breach territory for like most of July. I already know that, even though it's just the first day of the month, because this metric got as high as 250 in June, which is just astronomical, and I would like it to get to at least under 50 And so it'll take probably at least a month to come down since it's a rolling 30-day. Okay, so anyways, I look forward to the next monthly report in the beginning of August. It should answer a simple question. Did risk get cleaner? Or did returns still depend on too much hidden risk? So this is my own portfolio and my own capital. It is not investment advice. I am simply showing my process to be accountable and to hopefully provide some transparent education and make myself accountable. Okay, bye.